At his death, Cornelius Vanderbilt left behind approximately $100 million, one of the largest private fortunes America had ever seen. His son then doubled it. Yet within later generations, the Vanderbilts no longer controlled the railroad empire that had created their wealth. The fortune did not disappear in a single market crash or spectacular bankruptcy. The system holding it together was slowly dismantled. If you appreciate this type of content, gently tap that like button. Let us get into it. Most explanations of the Vanderbilt decline begin with mansions, parties, and irresponsible heirs. Those things mattered, but they were not the beginning of collapse. The real story starts with the difference between possessing money and controlling the machine that produces it. Cornelius Vanderbilt understood that difference better than almost anyone. He built his early wealth in shipping, moving passengers and cargo through some of America's most important commercial routes. When the economic advantage began shifting from water to rail, he shifted with it. He sold much of his shipping interest and concentrated his capital in railroads. This was not diversification. It was concentration. Vanderbilt acquired strategic rail lines, forced connections between them, and consolidated his holdings into an increasingly powerful transportation network. The New York Central System eventually linked New York with major markets across the country. Every passenger and shipment moving across those routes produced revenue. Every additional connection increased the value of the network. Control of the railroad also gave Vanderbilt influence over pricing, access, and competition. His fortune was therefore more than cash sitting in a bank. It was ownership of a productive system. That distinction explains what happened next. When Cornelius Vanderbilt died, his estate was valued at approximately $100 million. At the time, many skilled American workers earned less than $1,000 annually. The scale of his fortune was difficult for the public to comprehend. But Vanderbilt was not only concerned with how much money he would leave, he was concerned with who would control it. He had watched his son William Henry Vanderbilt work inside the family business. William had managed rail operations, understood the assets, and demonstrated that he could preserve the organization. Cornelius therefore left more than $90 million to him. The other children received far smaller inheritances. His surviving daughters received amounts ranging from roughly $250,000 to $500,000 each. His other son received income from a comparatively small trust. The distribution created resentment and eventually a legal challenge. But from a business perspective, the purpose was clear. Cornelius wanted to prevent the empire from being divided. A railroad cannot be managed like a collection of separate household accounts. Control depends on concentrated ownership. If voting power is distributed among too many people with different priorities, the family may remain wealthy while losing command of business. Cornelius placed most of the fortune with one operator because he believed concentrated ownership would protect the railroad. For a time, it worked. William Henry did not merely preserve his inheritance. He expanded the railroad and increased the family's wealth. By the time he died only 8 years after his father, the fortune was estimated at approximately $200 million. 2 generations had now performed the same essential function. Cornelius built the machine. William strengthened it. But William made a different decision about inheritance. Instead of placing nearly the entire fortune under one successor, he distributed large portions among several children. His sons, Cornelius Vanderbilt II and William Kissam Vanderbilt, received major stakes, while other children also inherited enormous amounts. No one became poor. The family remained extraordinarily wealthy. But something structural had changed. The original fortune was no longer one concentrated block of capital controlled by one person. It had become several fortunes held by several households. That sounds like a minor distinction. Financially, it was the beginning of the end. Imagine a family that owns 80% of the company. It can select directors, determine strategy, and protect the business from outside control. Now imagine that stake being divided repeatedly among children, grandchildren, and trusts. The combined family may still own valuable shares, but the people holding those shares no longer behave like one owner. Some want income. Others want liquidity. Some remain interested in the company. Others want to buy property, fund charities, or build lives completely separate from the family business. The value has not vanished, but the control premium begins disappearing. This is what happened to the Vanderbilt empire. Cornelius Vanderbilt II remained deeply involved in the railroads and continued as chairman of the New York Central. He expanded its reach and maintained the family's connection to the operating business. But he died relatively young. His brother William Kissam Vanderbilt subsequently withdrew from active railroad leadership and focused much of his attention elsewhere. The family's interest in managing New York Central gradually weakened. Professional executives and outside financiers became more important. The descendants still possessed wealth, but fewer of them were operating the system that produced it. Meanwhile, the character of their assets began changing. Railroad shares could generate dividends. A transportation network could reinvest earnings, purchase competing routes, and increase its economic power. But a mansion worked differently. A mansion could be enormously valuable and still consume cash every year. The breakers in Newport displayed the wealth of Cornelius Vanderbilt II. Biltmore represented the ambition of his younger brother George. Other Vanderbilt branches created estates in New York, Vermont, and across the fashionable communities of the era. These were not merely expensive houses. They were private institutions requiring large staffs, extensive maintenance, gardens, heating, repairs, and constant improvements. One example was Shelburne Farms in Vermont. Lila Vanderbilt Webb inherited $10 million and used much of it with her husband to assemble and develop an estate of approximately 4,000 acres. The property was spectacular, but it was not the New York Central Railroad. This does not mean the mansions alone destroyed the fortune. That explanation is too simple. The houses reveal a deeper transformation. Productive capital was being converted into lifestyle capital. A railroad is designed to generate cash from customers. A private estate is designed to provide comfort, privacy, and social status to its owner. One can compound capital. The other generally requires capital to survive. The family was replacing portions of the original wealth-producing machine with assets that carried substantial ongoing costs. The same pattern appeared through art collections, yachts, elaborate social events, and marriages into European aristocracy. Individual decisions that seemed affordable became far more consequential when repeated across an expanding family. At the same time, inheritance continued dividing the remaining capital. This created a mathematical problem. Suppose one fortune is divided among 8 heirs. Each heir then divides a portion among several children. Even if nobody spends recklessly, the number of claims on the original pool increases with every generation. Each beneficiary receives a smaller share of the underlying productive assets. If those beneficiaries also sell shares to finance homes, taxes, or personal expenses, the family's control declines even faster. The Vanderbilt name remained unified in the public imagination. The capital behind it did not. This is why saying that the family simply spent everything misses the mechanism. Spending was part of the story, but fragmentation made that spending more destructive. Cornelius had concentrated the fortune because he understood that $100 million under one operator could command an empire. William Henry's descendants inherited approximately twice as much wealth, but it was spread across more people with different objectives. The total was larger. The structure was weaker. Then the outside environment changed. The federal income tax became a permanent part of American life. Estate and inheritance taxes placed additional pressure on large family fortunes. Railroads also entered a more mature and regulated period, making it harder to reproduce the extraordinary expansion that had created the original fortune. Taxes were not the first cause of the Vanderbilt decline. The fragmentation had already begun, but taxation accelerated it. Frederick Vanderbilt provides an important counterexample. Unlike many relatives, Frederick significantly increased the inheritance he received. He lived comparatively quietly, invested heavily in securities, and eventually accumulated a reported fortune of approximately $80 million. His success proves that decline was not inevitable for every member of the family. But when Frederick died, more than $31 million went to the federal government, and more than $12 million went to New York State through estate and inheritance taxes. More than half of his reported fortune was transferred through taxation before the remaining estate could be distributed. Even the branch that had preserved and expanded its capital could not pass the entire amount intact to another generation. This is where the popular version of the story becomes misleading. The Vanderbilts did not suddenly become a family with no money. Different descendants retained properties, trusts, investments, and valuable names. Some built independent careers and fortunes of their own. What disappeared was something more specific. The family lost a concentrated block of productive ownership that had made Cornelius Vanderbilt economically powerful. There was no single moment when the fortune reached zero. There was a sequence. The railroad empire became multiple inheritances. The inheritances became separate portfolios. Parts of those portfolios became mansions, land, art, philanthropy, and personal spending. The remaining assets were divided again, taxed, and passed an even larger number of descendants. Each transaction could appear reasonable on its own. Together, they dismantled the original structure. Cornelius Vanderbilt had not created a permanent pile of money. He had created a machine that generated money because he controlled it. Once control weakened, the family increasingly depended on the wealth already produced by the machine. That wealth could be invested and preserved, but it could also be divided and consumed. It no longer possessed the same ability to reproduce itself at the original scale. That is the real reason the Vanderbilt fortune disappeared. It was not only a story about reckless heirs. It was a story about the difference between wealth and ownership, between an asset that produces cash and one that requires cash, and between a famous family name and a unified financial enterprise. The mansion survived. The name survived. Individual fortunes survived. The empire did not.